Hi everyone, welcome to our Wealthimize video where everyone can be free by maximizing your PPIG, protection, property, income and growth. Seong Yo with me today. Seong Yo, my growth investing partner. Of course, we're going to talk about his specialty options. So Seong Yo, I do understand that you are bullish on tech and you have quite a nice portfolio of tech stocks. And recently the market hasn't been very nice to you, of course, to me, and has coming down. So what's going to happen? What's going to happen from here? Are you very sad right now?
Okay, actually, I'm pretty happy. Let me elaborate. My fundamental outlook on technology sector has not changed. That means I'm still bullish on the long-term potential of the technology sector to grow.
Okay.
Okay, barring any black swan events and barring any external environmental factors like suddenly the Federal Reserve decides to increase interest rates to 10%, which is increasingly unlikely.
Okay.
I think they're doing a pretty good job on bringing inflation down. Oh, there's still a little bit of work to be done, but okay, that's another point. But the point here is, to your question, okay, the past 2 weeks has been painful for investors, all investors alike. But we're actually seeing green shoots of growth or even rebound.
Okay. Oh,
S&P
that's nice.
500, for instance, Nasdaq, they have shown a slight rebound in the recent week, towards the close of last Friday.
Okay.
And on top of that, we're also looking at the VIX index, the VIX, which is a rough indication of the fear factor in the market. And the VIX index actually has been going down. So
Okay.
I take all this as good signs in terms of the return of optimism in the market. And I should think that these are good indications of the market actually going to see a rebound in the near future.
Let me just understand VIX a little bit. So VIX, I think, yep, not many people know. Are you saying that once the VIX index is coming down, it shows that there's lesser fear and there's a good chance that market is going up? Does VIX work that way?
Well, it doesn't always work that way, but we can take it as a proxy. That
Okay.
means to say that if there is less fear in the market,
Okay.
then there's a chance that the market is optimistic and there's a lot of optimism in the market.
Okay.
So when there's optimism at play, when there's this good optimism at play, then you do see that investors are more willing to enter the market or re-enter the market, and this will have a positive impact.
Okay, so VIX index down, that means more optimism.
Yes,
Okay.
correct.
Wow, okay, but I do understand that you are in selling puts, right? So do you
Yes.
actually have puts that got a sign and then what's going to happen to them?
Yes, this brings back to your first question. Has my portfolio been affected? I would say that I'm actually happy that it happened this way because it is actually good for portfolio building. Let me elaborate. We did an options contract, a sell put options contract on this stock called Taiwan Semiconductor,
Okay.
or TSM for short.
Yes.
Now the sell put option basically is a contract where we are obligated to buy the stock if it falls below a certain price level.
That's right, yep.
So a month back, we entered into this contract where we sold put at a strike price of $95, meaning to
Okay.
say that if TSM drops below 95, we have to buy at 95.
Correct.
Now, when we entered this option contract, the market price then was about 110.
That's right, yes.
Okay, so market price was 110 here. We chose an option contract at this price,
Correct.
95.
Yes.
Right? So on expiration day, which was on 18th of August, the market price of TSM actually dropped to below 95.
That's
but
right.
a contract is a contract, so we had to honor it. We bought it at 95. Now, if you were to ask me, is it silly to actually buy at a higher price than what the market is actually asking for? Well, I look at it two ways. You see, we are already buying it at a lower price. When we enter this contract, we're buying it at a lower price when the market price is 110. We're already choosing to enter at 95. So when we actually have to buy, we're already buying at a lower price of 95 at a future date, which was just a little over 2 weeks back.
Okay.
Okay, that's number one. Number two, when we actually enter this contract, we're actually selling put. The fact that we're selling put means we're collecting some pocket money. That's
Yes.
called premiums.
That's
So
right.
it was, okay, not too shabby, $100+ premium. Number three, when we actually have to buy it at $95, we also look at another mathematical or financial formula called discounted cash flow, which is actually a mathematical formula to determine what is the intrinsic or fair value of the
That's right.
underlying
Yeah,
share.
correct. Yeah.
So TSM, the intrinsic value or DSF or DCF, sorry, discounted cash flow is in the range of 144 per share.
Okay.
So there are already a few factors to our advantage. Number one, we're already buying it lower than what was then the current market price, which is
That's right.
25 vis-a-vis 110. Number two, we're actually buying it at a value, meaning say if the actual value, intrinsic value of TSM is 144, we're actually able to buy at 95. So we just sit back and then wait for it to appreciate at a future date, and then we sell it for capital gains. So this is the beauty of using options to actually invest.
I do understand that if let's say you want to make a little bit more money from this trade,
Uh-huh.
you can actually sell call, right? Can you
Well,
elaborate a little bit more on
Yes.
this more?
So
Yeah.
now that we are obligated to buy at 95, which we have essentially, we bought it at 95. So what we do is in the meantime, rather than wait passively for the company, TSM, to declare a dividend and then we get some dividend income, we can actually actively go and sell calls, another variant of options investing. When we sell call, we're actually actively generating another stream of income for ourselves, because
Okay,
now
okay.
that we own this underlying stock, we have 100 shares at least, we can actually sell call contracts. And then the fact that we're selling calls means we are actively generating another stream of income through this options method called sell calls. And again, it will give us another stream of, let's say, 50, 100, maybe even a couple of hundred if the stock is a very high value stock. But in this case, TSM, okay, it's a very stable stock. We're very happy to own it in the first place, and we can actually use it to generate a constant stream of secondary income. So that's I would say that this is actually a win-win and win again kind of scenario. Number one, the first win is we're able to buy it at the lower than what was the market price. Number two, we're actually buying it at the lower than what is the fair value of the stock. And number
Correct.
three, we are actually using options, a sell call in this case, to actively generate another constant stream of cash flow for ourselves. So that is the wonderful thing about options if you know how to do it properly.
Thank you so much. So it seems that options is a lot more interesting rather than just buy the stock and wait.
Yeah.
There's various things we can do, and in fact, hey, now it's like when the market is up, it's good news. The market is down, it's not that bad news.
Not that bad news, yes.
Either.
In fact, the market is poised to go up, in my view, and I think we should all make the decision to start investing early. Get in while you can, and then if you're riding the correct wave, you can actually ride the rebound wave, and gain from that potentially.
Thank you so much. So this is Seong Yo and his thoughts on options investing. Especially at this point in time, our market is down. Hey, it's actually not bad, not that bad after all. So there we have it. So this is our Wealthimize video for this week. So if you have learned something, please help us to like, share and subscribe, and I hope to see you again very soon. Bye for now.